Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look again at why IV matters as some unusual option activity, especially on the call side, sets up for a couple trades to follow the big call buyer with a simple buy right, or follow it with a sell straddle or sell strangle to capture the vol and still lean bullishly with that call buying out there. So, as always, we like to take kind of a fusion approach where we look at the fundamental, technical, and especially the IV analysis. So let's jump in and take a look. First of all, here it is showing up on one of the screeners I use. You can see over 12,000 contracts traded, right, versus less than 3,000 average volume, more than 4 times the volume. More importantly, IV popped in a big way over 35 vol points, right? Simply because of this big option buying and especially call buying that basically increased the option premium, set up for a couple of nice trades. That buying was predicated on the fact that Akami got a, if you will, a double upgrade by Morgan from underweight to overweight. Rare that they do that. Raise the price target, right? So you can see that they expect more growth, right? They like the valuations. We'll take a look at in a second. Valuations, I think, getting a little stretched here. So let's jump over and take a look. Here's the valuations. Here's the PE, right? Trading at the highest multiple over the past 3 months at over 26 times. Price to sales, I took a 6-month look, right? Now over 3.3 times price to sales, also the richest multiple by far in the past half year. And then price to free cash flow, took a longer look there, a year look, right? By far the highest multiple there, almost 24 times price to free cash flow. So certainly Akamai getting a little extended, which should put maybe a little damper in the rally at some point. We shall see, but valuations do matter. Maybe not immediately, but when they get to extremes as they're approaching here, certainly they put a cap on the stock or a little bit of a headwind. From a technical perspective, took a look at the chart. Here you can see it's just kind of hanging right around that 90 level, right? You can see that getting maybe a touch overbought, not egregiously so. More importantly, IV, we'll take a look in a second at extremes here because of that big call buyer out there. And the trades that we have, basically the covered call, the sell straddle and sell strangle. Here's kind of the break-even points, 105-ish to the upside, right? Certainly a covered call, no upside, if you will, break even. It's all good, right? That's definitely a bullish trade. The downside around 85, so plenty of room to the upside. Would have to reach a new yearly high, right, to get in trouble on the trades. And then at support here, which it bounced off of several times, so kind of like it from a technical perspective as well. From an IV perspective, we always like to take a look at that. Here you can see the IV. I took a 60-day IV, and you can see just reaching out to the highest level we have seen since the last earnings report. You can see from the previous day to today, and this was going back a couple days, right? That huge jump in IV, right? Moving from the red line the previous day to the green line. So a big spike in IV predicated on this huge increase in volume, right? You can see over 10,000 calls traded, right? Under 2,000 puts. You can see the sizzle index, right? Which we like to kind of look at, right? Now over 8 times, which is high indeed from a sizzle standpoint. So things getting a little bit rich here. IV percentile now at 58% compared to the historic IV of just 13%. You can see the volume starting to pile in here. The February and March volume and even May certainly showing up in a big way. You can see that jump in implied volatility. Here's a kind of generalized look, right, at IV at the money. You can see that spike from the 9th, from Friday, last Friday to Monday, a huge spike from under 40 to well over 40, almost 50. You can see it was hanging out in the low 30s, upper 20s before that. So certainly IV, which means option prices have gotten extreme. Here's a look at a 60-day, slightly out of the money call, 30 delta call. You can see that massive run up, that massive spike. You can see previous spikes here always were met with a reversion. So that's set up ideally for a couple trades here. The simple one really being a buy right, which is simply going out, buying the stock, selling the slightly out of the money calls. And for context, right, here is kind of the time period that I'm doing the comparative. The last time the stock was up here compared to now. So we're going back to December 24th, the stock at 89.23. That Feb 95 call, right, trading at about $2.20. So the buy right, buying the stock, selling the call, costing a little bit more than 87 bucks. The IV just under 30. 58 days to expiration back in late December. Theta's 4 cents a day you'd expect to make on the call simply as a function of time. Fast forward to the 14th when we put the trade on, the stock closed at 90.65. So the stock was higher, right? Moved up higher. The call moved up, but even more than the stock. We'll take a look in a second, right? So the call moved up bigger than the stock did, which means the buy right, buying the stock, selling that call actually got cheaper with the stock higher and with less days to expiration. You'd expect that buy right to improve as a function of time with the stock really not moving dramatically, right? But because of this huge jump in IV, right, we got to get into that buy right for much cheaper. So here's the comparative December 24th, the stock at 89.28, that Feb 95 call trading at 220. The buy right, buying the stock, selling the call would have cost 87.08. IV just under 30. 58 days to expiration. Fast forward to the 14th, the stock now higher, 90.65. Stock went up $1.37. The Feb 95 call, which is out of the money, right? The Feb 95 call, carrying less than a 50 delta, improved by $1.70, right? You can do an implied delta, if you will. I always like to do that. Take the move in the call divided by the move in the stock, and you can see the implied delta on it. Over 100, a 124 implied delta. So that buy right actually got cheaper with the stock going up and with 21 days passing, right? So why? Because of that massive jump in IV from just under 30 to nearly 50. So this sets up ideally for a covered call trade. Buy the stock, sell these slightly out of the money Feb 95 calls at a very rich price. Follow that option buying. Lean bullishly, you'd be a bit more than 50 deltas net long on the trade, right? Buying the stock and selling that 42 delta option. So you'd be 58 deltas net long. A couple other ways to attack it, right, where you're selling both sides, capturing more premium. I looked at the Feb 95 straddle, right, going back again to our original date, December 24th, stock at 89.23. That Feb 95 straddle, selling the call and the put, trading $9.70. You'd be 33 deltas net long, right? With the stock at just under 90, the 95 put deep in the money, 95 call out of the money. So a bullish trade, you'd expect to make money if the stock went higher by selling this, right? IV, right, just under 30, 7 cents a day. Theta, you'd make 58 days to expiration. Fast forward to the 14th, the stock went up, right? So if you sold that straddle, you'd expect to make money, right? But no, the straddle actually increased in price, right, to $11.95. Why? Because of that massive jump in IV from under 30 to almost 50. You're still net long, even with that move higher, you'd still be bullish, right? 11 deltas net long. 39 days to expiration. You expect that to get cheaper as a function of time, but because the IV jump simply negated all that, right, set up ideally for a sell, straddle in February, lean bullishly, right, you'd still be 11 deltas net long. So the stock over that time frame from December, late December to the 14th, increased a couple bucks. The delta on the trade, a little bit over 20, so you'd expect to make 44 cents or so on the trade as a function of the delta. Theta, you'd expect to make a couple bucks because you are short theta both on the call and the put, but instead you actually had the trade go up over $2, so your vol capture well over $4, you would expect to have made about $2.50, but instead you would have lost about $2, right? So doing it now, you can capture vol of 459. I did a quick sort of, let's revert the vol back to 40, right? Not all the way back to where it was before, but simply going back to down here, right? This big pop and drop. So somewhere in this area was where we put in, if the IV dropped to 30, the Theo on the trade would be 1067. You're able to sell it for 1195. So you got about $1.20 of edge on that trade. Same thing with the strangle trade, right? Same idea here. Stock back in late December, 89.23. Selling the 90 put and the 100 call, right? The 90 put was slightly in the money. 100 call well out of the money. Would have gotten you $7.70. You'd be 20 deltas net long, right? Days to expiration, because we're going out to March 86. The IV a little bit under 32, and you'd make money obviously as a function of time. Fast forward to the 14th, the stock did go up, but you still have plenty of room to the upside on the 100 call. The 90 put now slightly out of the money, right? But still, you'd be net long 11 delta, still a bullish trade. So you have the stock moving up, but this strangle increased to 855 before it was at 770, right? So you have an 85-cent pop in it, even with time passing, right? You have less days to expiration. Why that big move? Because the IV exploded to over 40 back here. It was just over 30. So this sets up ideally for that March strangle trade, right? So the stock over that time frame, as we said, gaining, right? The smooth delta, you'd expect to make 19 or so cents by selling that strangle. Time passed, right? You'd expect some theta gain, but actually you had a loss, if you will. That strangle got more expensive by 85 cents. And why? Because that huge jump in IV. So we reverted the IV back to 36 here, right? And the Theo would have been $7.36. You can sell it for over $8.50. So you have about $1 edge on the trade selling it here, simply because of that huge volume goosing up the price of the option. So it sets up ideally for a sell strangle, where you're selling inflated IV on both the call and put side. Same with the Feb straddle. On the buy right, you're selling inflated calls, leaning a little more bullishly, obviously, with that call buyer out there. So hopefully explains how we go about identifying opportunities, how we go about positioning to profit from that expected IV reversion, right? But as always, trading is about probability, not certainty. Make sure you position size properly. Make sure you have your exit strategy predefined and adhere to it. If you don't know where to get out, you shouldn't be getting into the trade. So until next time, as always, here's the good trading. Take care.